and welcome to the Global View on this Tuesday. Well, US Treasury yields have moved higher as investors prepare for two auctions as well as the Federal Reserve's two-day meeting, which begins tomorrow. Markets are priced in a hold from the Fed, although it's not anticipated that it will signal a shift from its tightening policy stance. The FOMC meeting will convene on the same day as November's Consumer Price Index is released, which is expected to show inflation is cooling, but remains above the Fed's 2% annual target. Well, the yield on the 10-year Treasury note rising to 4.26% and the 2-year up to 4.76%. The US dollar climbed against most major currencies ahead of November's inflation report, while the yen slid on fading hopes of a change to monetary policy from the Bank of Japan. The Aussie, they're trading at 65.7 US cents. And the COP28 UN Climate Summit in Dubai looks set to end with no deal on phasing out fossil fuels, with some oil-producing nations intent on using language that refers to reducing consumption and production of fossil fuels in a just, orderly and equitable manner. Well, Charlie Munger, Warren Buffett's trusty lieutenant at Berkshire Hathaway for almost 60 years, died recently at the age of 99. Under their management, Berkshire averaged an annual gain of more than 20% from 1965 through to 2021, almost twice the pace of the S&P 500. Well, clearly they were doing something right. To get an insight into the investment philosophy of Charlie Munger, we're joined by Rob Shears from Valor Private Wealth. Rob, a very good morning to you. Thanks for joining us.
Andrew.
99 is not a bad innings, was it? Quite remarkable, in fact.
1 month before his 100th birthday.
Yeah. Didn't quite get there. But look, interesting. Now you're going to take a look at, as I said, sort of his investment philosophy and some of the learnings, I guess, from him. But I was looking at a quote from him saying, it's remarkable how much long-term advantage people like us have gotten by trying to be consistently not stupid instead of trying to be very intelligent.
Very true. Very true. It's and if you look at what they've done over the multi-decade period, a lot of the things they did were really quite obvious in hindsight, but actually simple investments. You look at Coca-Cola. That's not a difficult investment to understand, and almost anyone could have understood that investment back when they bought that in the mid 80s, the 1980s. I think that a lot of people don't realise that simplicity is an investment strategy, and avoiding doing dumb things is a huge part of should be a huge part of someone's investment strategy. We're always convincing ourselves we know more than we do, and the first tenement of Warren Buffett's 4 filters is know your circle of competence, understand what you're investing in, and Charlie always espoused that.
Yeah, and that, as you say, he simplified it essentially and into 3 buckets of investing.
Yes, so the wonderful quote, there's 3 buckets of investing. There's yes, no, and too hard basket. And I think that a lot of people are thinking they know more than they do on most investments. You really can't understand about 95% of the stock market, or understand what the likely outcome over the next decade is for most of the stock market. So avoiding having an opinion on that is very important to know not to convince and hoodwink yourself.
He also, both he and Warren Buffett, of course, having a focus on quality stocks. What was their definition of that?
So Charlie was always, and Charlie actually influenced Warren on this, looking for high return on capital, but sustainable high return on capital investments for decades. And he was looking for these companies where they could reinvest back into that business. And his favourite business was Costco, which is one of the highest, if not, I think, the second highest quality business in the world, potentially behind Berkshire Hathaway. Costco is, you just can't compete with Costco, and it's going to keep on growing for the next couple of decades. So high quality businesses is where you should have your money.
All right, now talking of baskets there, I guess they also had that philosophy of not putting all your eggs in one basket, diversification being the key.
So actually the opposite. So Charlie was very much about non-diversification and trying to find situations. He said, the art of investing is trying to find situations where you don't need to diversify. So Charlie had 4 investments, and it was that way for decades. He owned Costco, Berkshire Hathaway for decades, but he wasn't buying and selling these things. He might have been selling a number of these things for investing, for allocating to philanthropic reasons, but he effectively didn't do anything for decades on a lot of his investments. But he only had 4 investments.
But that, I mean, everything and everyone I speak to says you need to be diversified. Why did that work for him then? That the opposite approach.
Charlie actually was very vocal about this. He actually thinks that if you're an expert, then diversification is absolutely insane. So he used to say that, well, if you know you're going to make 20% from one stock and you're going to make 5% from another stock, why in the world would you diversify? And he used to call it diversification. Why in the world would you put half in the 20% of your stock and half in the 5% of your stock? It just doesn't make any sense. So if you know what you're doing, diversification is completely irrational. He did say, though, that if you know less, then you should diversify. But the experts should not be diversifying. And you're really going to get average returns. And you look at all the managed funds around the world getting average returns because they got too many stocks.
Now, Rob, also, we know that well-worn phrase of investing, it's not timing the market, it's time in the market. Did that apply to him as well?
Absolutely. We're talking about someone who thought, and I think that the long-term investing mantra has been bastardized somewhat. So people say long-term these days, they're talking about 1 to 2 years or 1 to 3 years, maybe at a stretch 5 years. So we probably need to reframe the mantra as ultra long-term investing when you're talking about decades. And Charlie owns the Daily Journal, which he invested in 1977. We're talking about multi-decade investment periods. And he said, you want to find the best investors where you can just sit on your ass and let the compounding do its thing. So another quote he said was, never interrupt compounding unnecessarily. So he was really talking about ultra long-term investing, and so few people practice this.
Yeah, it's the art of doing nothing, isn't it? Which I guess is pretty difficult from an investor point of view. You feel tempted.
Very much so, yes. But when you know you've got a better business than everything else, the art of doing nothing is beautiful.
All right. Now, preparation also clearly a key here.
Yeah, so Charlie was all about preparation, and if you look at pre-GFC, he knew the GFC was coming, so so he could see the folly of what was happening in the investment markets. So his Daily Journal investments, where he controlled the investments, was pretty much all cash. And then in 2009, he pretty much invested most of it in banks. I think it was near over 85% went into 4 different banks. And so he said, I get the quote right, sorry. Our game is to recognize a big idea when it comes along, and one doesn't come along very often. Opportunity comes to the prepared mind. So being prepared for these opportunities is really important. Doing nothing for long periods of time and then taking action is a very unique skill.
Yeah, I guess it goes to that point. There's no such thing as dumb luck. It's all about, smart luck, if you like. You got to make your own luck.
I think Bitcoin is proving that there is dumb luck in the world, and there's nothing wrong with that. Charlie called it rat poison. Warren then went on further to call it rat poison squared. So Charlie was very vocal about things he detested, which he didn't call. He called a spade a bulldozer, he didn't call a spade a shovel. He really let people know what he thought.
All right, but bottom line, look, he didn't want to make a loss anywhere, did he?
He was always looking to avoid loss, and he understood the asymmetric mathematics of investing. If you lose 50%, you're going to make 100% to get back to where you started. So he was always looking at, and his famous quote, which he repeated very regularly, was, "All I want to know is when I'm going to die, so I don't go there." And that is really about trying to find out where you could lose money to avoid that area. And he was always looking at the folly of markets and looking at where not to go, and that's really important in investing, and so few people are looking for these areas of pain. So it's an interesting factor.
All right. Oh, it looks like we've lost you there for a moment.
No, I'm still here.
You're
Sorry.
back. Okay. Rob, also, I guess there's a question who's looking for those companies where the founders, the board members and so on, putting their money where their mouth is.
Absolutely. So if you look at, sorry, there we go. It's, if you're putting your money where your mouth is, they're very focused on the incentives. And Charlie always used to say, "Show me the incentives, and I'll show you the outcome." And incentives was more important than almost anything else. I think I like the pilot example. The pilot going to Los Angeles wants to get there because he's on the plane, so he has the same incentives as the passengers. Yet we look at so many managers and boards these days. They have no investments in the companies they run, or if they do have very small amounts, it's a fraction of their wealth. They don't care really deep down what's going to happen to that business. It's what Charlie did and what Warren does. They're looking for people who have all of their money, or the vast majority of their money, which Charlie and Warren did in Berkshire Hathaway, in the investment that they're running, and that's just really tying the incentives to the outcome.
And he was all about transparency, and that goes to his point about avoiding accounting trickery. I see that he mentioned the acronym EBITDA. He said you shouldn't be looking at that.
Yeah, I don't know if I can use this term, but he said whenever you see the term EBITDA, just substitute that with bullshit earnings. You can probably beat that one out, but that's Charlie in a nutshell, calling a spade a bulldozer. But it's true. It's if you look at 2021, there was more fake earnings, is the best way to describe it. Earnings which were never going to be converted into free cash flow per share, because these companies were being run for the employees, not the shareholders, with ridiculous levels of shareholder money going to the employees in terms of employee compensation and shares and share-based compensation. And to the point where there was one company which had 73% of the revenues in share-based compensation. Now, these companies are uninvestable. And there was a huge cohort in 2021. Most of these companies are down 90 to 95%. They've had a huge rally this year, but rallying from down 95% means you're still down 90%. So these are uninvestable businesses. And Charlie warned everyone, but few people listened.
Rob, of course, we're at that time of year where we start thinking about what comes next in 2024. And I guess you only have to look at that philosophy from Charlie Munger and Warren Buffett about then. They weren't about forecasts, were they? No crystal ball in sight. With that in mind, I mean, how would you be approaching, the year to come? What do you look for?
Look, I don't think Warren Buffett's quote. Forecasting tells you very little about the forecast, but it tells you a lot about the forecaster. So I think that you can't really forecast a 12-year return, a 12-month return. Anyone predicting where the stock market's going to be in 12 months, it's just completely irrational. What I do think you can do is think in a probabilistic sense where we are on the range of probabilities due to valuations. And certainly we are at the upper end of the range. The two most important markets for most Australian investors, but in terms of global thinking, is the Wilshire 5000 index to GDP, which is what Warren Buffett called the single best measure for valuations any given time. That's currently sitting there at about 167. You can see there on the chart there, it's above the dot-com bubble and well above November 2007. It is below 2021, where we're in this everything bubble, which was craziness. But it's definitely not at that near that 50% ratio where it approached in 2009. So if you said to me, are we going to make 14% a year for the next decade, I would say the probability is next to zero. If you said to me, are we going to make closer to a zero return for the next decade, I think the probability is much higher than a reasonable return. So I think probably if you look at a range of outcomes, the range of outcomes is I wouldn't expect optimism is the best word to describe that.
Rob, terrific to get your view and look back, obviously, on the life of Charlie Munger and his investment philosophy. Thanks for joining us from Valor Private Wealth.
Thanks, Andrew.
All right, that is the global view. Just before we go, a quick check of where we're likely to get going. As you can see, SPY futures up there modestly. Stay with us. The Open is next.